name is Fazalia and I will be explaining the Semester 1 question 2019-2020. For question 1, the key concept is short-term loan, management for current asset and aggressive funding strategy. A. Describe how CNC could adopt either a more aggressive or more conservative financing policy. If CNC wants to adopt a more aggressive financing policy, it could opt for increased short-term financing, relying more on trade credit and short-term bank loans. On the other hand, if the CNC adopting a more conservative financing policy, it would involve relying more on the long-term financing and minimizing the short-term debt. B. State two advantages and two disadvantages of using the short-term credit as a source of financing. First is the flexibility, where short-term credit provides the flexibility, allowing CNC to adjust its financing needs based on the seasonal demands of its business. Second is the cost effectiveness. Short-term credit often has lower interest rate compared to long-term financing, resulting in lower overall financing costs for CNC. Meanwhile, the disadvantages of using the short-term credit is the interest rate risk, where the short-term credit is susceptible to interest rate fluctuation, exposing CNC to potential increase in borrowing costs. Second is the refinancing the risk. There is a risk of difficulty in refinancing the short-term debt, especially during economic downturns or tight credit markets, which could strain the company's liquidity. Moving on to C. Calculate the effective annual cost rate assuming the normal loan and the discount loan. For the normal loan, we are using the formula that has been given where 1 plus the I divided by n, source of power n, minus 1. So we got the answer is 8%. Meanwhile, for the discount loan, the effective annual cost rate is same as the nominal interest rate, which is 8%. D. Explain the pros and cons of borrowing on a secure versus unsecured basis. For the pros of secure borrowing, the lenders typically offer lower interest rate for secure loans since they have the security of collateral, reducing their risk. Meanwhile, the cons is there are more complex application process due to the need for collateral appraisal and the legal documentation. Pros of unsecured borrowing is the borrowers don't risk losing specific asset if they default, making it less financially for them. Meanwhile, the cons of unsecured borrowing is there would be the higher interest rate because lenders assume a higher risk without collateral. E. Describe three characteristics of asset that can be collateral for a short-term loan. First is tangibility. Collateral for short-term loans needs to be tangible, meaning it has a physical presence. This could include the inventory, equipment, or real estate that can be assessed and valued by the lender. Second is the marketability. The collateral should be easily marketable, meaning it can be sold or liquidated relatively quickly. Third is the stability in value. Ideally, collateral should have stable and predictable value because this helps lenders assess the risk associated with the loan more accurately. Moving forward to the question 2 part A. The key concept for this question is capital structure, leverage, and dividend policy. A. Discuss whether changing the capital structure of a company can lead to a reduction in its cost of capital and hence to an increase in the value of the company. To answer the question A, yes, changing the capital structure of a company can potentially lead to a reduction in its cost of capital. Why I said so? Because introducing more debt in the capital structure can lead to lower cost of capital. Second is because the interest on debt is tax deductible, providing a tax shield. Third is because having a mix of debt and equity allows for flexibility in capital structure adjustment based on the market condition. Additionally, a well-balanced capital structure may positively influence the investor perception. If the investor perceives the company's financial structure as optimal and sustainable, it can result in a lower required rate of return, contributing to a reduced cost of the capital. B. Calculate the firm's operating break-even point in units and RM. So first and foremost, we find the contribution margin, where the selling price minus the variable cost. 35 minus 21, we got 14 for contribution margin. Then we will find the break-even point in units. So we are given the fixed cost 1050000. We divide by the contribution margin, so we got 75,000 units for the break-even points in units. For the break-even point in RM, we just multiply 75,000 by 35, which is the selling price per unit. So we got the break-even point in RM is 2625000. Okay, next, for the B second Roman, the question is, using 100 units as a base, what is the firm's degree of operating leverage? So to answer this question, we have to input all the information that we have into the formula. So we got 4.0 for degree of operating leverage by dividing the 1.4 million divided by 350,000. For the part B, the board of directors of ABC Berhad have requested you, the financial director of the company, to write a report to advise them. So, ABC Berhad must follow the few conditions where the borrowing must ensure the stable dividend payments, fostering the investor confidence and potentially attracting the new investor. Furthermore, ABC Berhad can utilize the borrowing for dividends, allows the company to preserve the cash surplus for strategic purpose like potential investment. The cost of debt needs careful evaluation against the benefits of maintaining the dividend stability. ABC Berhad also need to consider the economic conditions and interest rate trends. It is crucial to assess the feasibility and cost effectiveness of borrowing. For second Roman question, the likely effect on the company's cost of equity if the company decides on share repurchase or future borrowing. Okay, so the effect of the share repurchase is the positive effect can signal the confidence, potentially leading to a higher stock price. It also may give the impact on cost of equity, where a higher stock price may lower the cost of equity due to reduced perceived risk. Meanwhile, for the future borrowing, it depends on how borrowed funds are used. If the funds are used wisely, cost of equity may decrease. Otherwise, increased financial risk could raise the cost of equity. Moving forward to the part C question, determine the total dividend and dividend payout ratio for BA series Berhad. For the new financing or investment has been given, which is 600,000. Then the net income is forecast at 500,000, known as the retained earnings. Then the equity needed has been given the ratio, which is 50% from 600,000 of the new financing. So we got 300,000 for the equity. Then we just have to deduct the retained earnings with the equity needed, which is we got the total dividends of 200,000. Moving to the dividend payout ratio, we just have to take the amount of total dividends 200,000, we divide by the retained earnings, which is 500,000, so we got 0.4% of dividend payout ratio.
Moving on to question 3, part A. The first requirement for question 3 is describe a merger, an acquisition and a consolidation. So, merger is a transaction in which two firms combine to form a single firm. In a merger, the distinction is less clear. We can classify the acquiring company, which is the bidder who initiate the transaction, and the seller who received the offer. But merger and acquisition often used interchangeably. Acquiring company retain its identity in either merger and acquisition, while target firm cease to exist. While acquisition is the purchase of one firm by another. We can see a clear distinction between the buyer, which is the bidder, and the seller, which is the target firm acquisition. And consolidation is another type of merger in which an entirely new firm is created. A consolidation absorbs both the bidder and target firm into his new firm, and all firms cease to exist as separate entities. second requirement is using NPV, evaluate whether or not CCPLC should acquire AAPLC. To evaluate whether CCPLC should acquire AAPLC, we should first find the incremental value. Therefore, firstly, calculate the cash flow without merger for CCPLC that growing 2% annually in year 1, 2, 3, and 4. Next, calculate the cash flow of CCPLC with merger growing 6% annually in year 1 until year 4. Then, we should minus the value of CCPLC without merger from CCPLC with merger to get the total incremental value for each year. And that incremental value will grow at rate of 2% after 4 years. So for that year, we should multiply by another 1.02% and divide it by 7%. From the incremental value, present value can be calculated using financial calculator. So, at year 1, input 3.4 million as future value, 1 as N, 9% which is the cost of capital, SI, and press PV. After amount present value of each year are calculated, total present value will be added. Then minus 58 million, which is the ask price by total present value. And the answer we get is positive. Therefore, this means CCPLC should acquire AAPLC since the wealth of CCPLC will increase. Moving on to part B, the question is about Jitu Corporation and Cepat Corporation. And the key concept of this question is merger. So the question is, Cepat Corporation is going to give Jitu Corporation a 60% premium over Jitu's current market value. What price per share will it pay and what is the total market value of Jitu Corporation? So based on the question, there is 60% of increment to Jitu and market price per share for Jitu is Rm30 ringgit. Same goes to Cepat. Therefore, to find price per share of Jitu is market price per share, which is Rm30 ringgit, multiplied by 60% of increment, and the answer is Rm48. From the price per share of Jitu, which is Rm48 ringgit, we can then calculate the total market value of Jitu. Is Rm48 ringgit multiplied by number of shares outstanding, which is 400,000. Therefore, we will get total market value of Jitu is Rm19,200,000. Requirement B. How many shares must Cepat Corporation issue to buy Jitu Corporation at its new total market value? Total share Cepat need to issue to buy Jitu at new market value can be calculated by divide Jitu new market value, which is 19,200,000 by market price per share, which is 30 ringgit. Therefore, total share Cepat need to issue is 640,000 shares. Requirement C. Calculate the post-merger earning per share. The formula of EPS is total earning divided by share outstanding. Therefore, after post-merger, the total earning is 5 million divided by new share outstanding, which is 2,640,000. And earning per share is Rm 1 ringgit 89 cents per share. The last requirement for question 3 is discuss the impact on EPS of the merged company. So the impact is there is reduction in EPS of merged company. This is because when Cepat offered to issue shares at premium, price earning ratio of target company will be higher, which is 19.2 than Cepat's price earning ratio. Thus, it will lead to immediate effect of EPS reduction. But with merger, that able to lead to synergistic effect, which is the increasing in potential growth rate. The reduction in EPS will be overcome in future. Moving on to the last question of this paper, part A, the question is, Al-Ikhlas Sports Equipment must decide whether to obtain RM1 million of financing by selling common share at its current price of RM40 per share or selling convertible bonds. Firm currently has 250,000 shares of common shares outstanding. Convertible bond can be sold for their RM1000 par value and will be convertible at RM45. Firm expects its earning available to common shareholder to be RM700,000 each year over the next several years. So the key concept of this question is dividend policy. The first requirement is calculate number of shares firm will need to sell to raise the RM1 million. So based on the question, the current price is RM40. Therefore, to get number of share firm will need to sell is RM1 million divided by 40, and we will get 25,000 share, which is the share firm will need to sell to raise RM1 million. B. Calculate earnings per share resulting from sale of common shares. Formula of EPS is net income available to ordinary share divided by number of share outstanding. So based on the question, the net income available is 700,000 will be divided by 250,000 share plus 25,000, and we will get the final answer of RM2.55. Moving on to the next requirement, calculate number of shares outstanding once all bonds have been converted. So based on the question, it says convertible bonds can be sold for their RM1000 par value and will be convertible at RM45. Therefore, RM1 million will be divided by 1000 of par value. We will get 1000, and 1000 will be divided by 45, which is the convertible price to get conversion ratio, which is 22.22. To calculate share outstanding after conversion, 1000 will be multiplied by conversion rate, which is 22.22, and the answer will be added to the current share of the company, which is 250,000, and we will get number of share outstanding once all bonds have been converted, which is 272,222.22. Next, calculate earning per share associated with bond financings after conversion. So basically, we should follow EPS formula, which is net income available to ordinary shares 700,000 divided by new number of share outstanding once all bonds have been converted earlier, and we will get the answer of RM2.50. The last requirement is which financing alternative you recommend the company adopt and why. The answer is the best decision for Al-Ikhlas Sports Equipment is to sell common share. This is because lower financial risk. Convertible bonds come with additional risks like conversion uncertainty and potential call feature, which can disrupt future financing plans and impact shareholder value. Common share offer more predictable financial structure and align with future expectation. If Al-Ikhlas anticipate significant future growth and stock price appreciation, using common share can capture potential upside efficiency for existing shareholders. Moving on to part B, the question is, a warrant is attached to a RM1000 par 10% 15-year bond, paying annual interest and having 10 warrants attached for the purchase of the firm's share. The bonds were initially sold for RM1020 ringgit when issued. Similar risk trade bonds were selling to yield 12% rate of return. The key concept of this question is warrant. First requirement, calculate the implied price of warrant. The formula of implied price is price of bond with warrant attached minus by straight bond value. So price of bond with warrant attached is given in the question, which is 1020 ringgit. So we should calculate for straight bond value. Using financial calculator, input 1000 as FB, 15 as N, 10% multiply by 1000 as PMT, 12 as I, and press PV. And we will get RM 863.78. To get implied price for this question, RM 1020 ringgit minus RM 863.78, and we will get RM 156.22, but that is for 10 warrant. So to get the price of warrant, the answer should be divided by 10 warrant, and we will get the final answer of RM 15 ringgit 0.62. Next, explain key characteristic of stock purchase warrants, the implied price of an attached warrant, and the values of warrant. So the key characteristic of stock purchase warrants are: it is often attached to debt issues as witness to add to the marketability of the issue and lower the required interest rate. Warrants normally have life of not more than 10 years, although some have infinite life. It is usually detachable, as bondholder may sell warrant without selling underlying security, often listed and actively traded. Key characteristic of implied price of an attached warrant is: when attached to a bond, the implied price of warrant can be found using the equation of implied price of all warrants equal to price of bond with warrant attached minus by straight bond value. So dividing implied price of all warrant by number of warrant attached to each bond will result in implied price of each warrant. And the key characteristic of the values of warrant is like convertible. Warrant has both a market value and theoretical value. Difference between these values depends largely on investor expectations and ability of investors to get more leverage from warrants than from underlying stock. The theoretical value of warrant is the amount one would expect warrant to sell for in marketplace. This is the formula that can be utilized to calculate for the values of warrant. The last part, which is part C, the first requirement is: what are the long-run advantages of having more local debt and less MNC-based equity in capital structure of a foreign subsidiary? First advantages is reduced currency risk, which local debt typically denominated in local currency, which may help mitigate currency risk. When subsidiary has more local debt, it is less mitigate currency risk. When subsidiary has more local debt, it is less exposed to fluctuation in exchange rates, providing stability in its financial position. The second advantage is lower financing costs. Local debt might offer lower interest rate compared to international financing options. This can lead to lower overall financing costs for the foreign subsidiary, improving profitability and finance performance in long run. And the third advantage is improved relationship with local stakeholders. Relying more on local debt can strengthen subsidiaries' ties with local financial situation and stakeholders. This leads to better relationship, improved access to local markets, and deeper understanding of local business conditions. Next, discuss two means for MNCs to raise equity capital abroad. So the first means for MNC to raise equity capital abroad is Global Depository Receipts, GDR. MNCs can issue GDR to raise equity capital in foreign market. GDRs are negotiable financing instruments representing companies' share. They are typically issued in a foreign currency, making it attractive for international investors. Process involves depository bank issuing GDR on behalf of MNC, which can then be traded on international stock exchange. Investor can buy and sell GDR like regular stock, providing indirect way for MNC to raise capital abroad. And the second mean is foreign direct listing. This is through foreign direct listing on foreign stock exchange. If involved, listing companies' shares directly on foreign market, allow it to access new pool of investor and increase global invisibility. This method provides MNC with advantages of tapping into diverse investor base and potentially benefit from different market conditions. It will enhance liquidity and foster broad shareholder issue.
Hi, my name is Nur Natasha binti Rahman. I will present the question, the set of question of SAM 2, 2021 and 2022. Okay, so for the question 1, Suzam Sdn Bhd has annual sale revenue of 10 million and all sales are on 35 days credit by customer take an average of 10 days more to pay. Contribution represent 55% of sale. Current bad debts are 2% of sale. Account receivable are financed by an overdraft at an annual interest of 6%. Plans to offer a 5 early settlement discount for payment within 10 days. And plans to extend the maximum credit offer to 50 days and expects a 10% increase in annual credit sale with additional incremental cost equal to 1% of turnover. Okay, so Suzam Sdn Bhd expects bad debts to reduce to 1% of sale, expects the discount to be taken by 50% of customer, and currently has an average inventory of 1 million, and receivable conversion period is always twice as long as its inventory conversion period. And Suzam Sdn Bhd always pays creditors on time. Credit term net 30 days. Okay, so question 1A is analyze and recommend whether or not Suzam Sdn Bhd should change its credit policy. Okay, so for the question number 1A, analyze and recommend whether or not Suzam Sdn Bhd should change its credit policy. Okay, so in this situation, we will calculate the cost of benefit analysis. Okay, so first of all, we will calculate the increment in sale. As stated in the question, that after Suzam change its credit policy, they have 10% increase in sale. So to calculate the new sale, 10% we multiply with 10 million. And we plus with 10 million and we get 11 million. Okay, so from that, we also can calculate the new variable cost because we have the value of sale and the value of contribution margin, which is stated in the question, 55% of sale. Okay, so to know the increment in sale, we will minus the value of new sale with the value of current sale, and with that we will minus a 6.05 million with 5.5 million and we get 550,000 for the increment in sale. Okay, so next we will calculate the change in credit policy. As stated in the question, the current SEP is 45 days and we will calculate the new SEP, and based on the information given, which is early settlement discount, 5% within 10 days and 50% take the discount and remaining pays within the given period. Okay, so to know the exact amount of SEP, we will multiply the 50% with 10 days for the customer who take the discount, and we will plus with 50% multiply with 50 days, the remaining customer that pay within the given period. So after we calculate, we get 30 days the new SEP. So we as we see, they have a decrease in SEP. Okay, so what that we have to calculate is the difference between the financing cost for the current and new ACP. So for the current ACP for 45 days, Suzam Sdn Bhd have cost of have financing cost of 562,500. And for the new SEP, Suzam Sdn Bhd have financing cost of 412,500, Okay, so we need to find the difference between the financing cost of Suzam Sdn Bhd, and with that we will minus 562,500 with 412,500, which is we get the amount is 150,000. Okay, so based on the equation that Suzam Sdn Bhd have overdraft at annual interest 6%. So therefore we multiply 150,000 with 6%, that we get 9,000. Okay, so next in the question also have mentioned that after Suzam Sdn Bhd change its credit policy, there will be decrease in bad debts. So to know the decrease, we will calculate the current bad debt and the new bad debt. Okay, so the current bad debt is 2% from sale, so we get 200,000, and for the new bad debts is 1% from sale, so we get 110,000. So the amount that decrease in bad debt is 200,000 minus with 110,000, which is amounted 90,000. And then also have after they change the credit policy, they also have increased cost in discount, as Suzam Sdn Bhd offer early settlement discount, which is 5% for people who pay within 10 days. So the increased cost is, we will multiply sale with percentage of discount and percentage of people who take the discount, which is we get 275,000. Okay, so next we also have incremental cost, which is 1% of turnover. So we get 110,000. Okay, so after we calculate all the effect from the change of credit policy, we will make analysis with cost benefit analysis. So we will add up all the increase in sale, decrease in SCP, and decrease in bad debt, and and after we get the amount, we will less it with increased cost in discount and incremental cost, which is we get net benefit of policy change, which is 264,000. Therefore, I would recommend Suzam Sdn Bhd to change its credit policy, because he will get benefit amounted to 264,000. Okay, so for the question for B, explain 3 benefits to Suzam Sdn Bhd for offering an early settlement discount for its customer. Okay, so the benefit is first, offering an early settlement discount encourage customer to pay sooner than the standard payment terms. Therefore, it will improve the cash flow of Suzam Sdn Bhd and can help him in managing his financial obligation and operating expense. And for the second benefit is early settlement discount would reduce bad debt risk. For instance, by setting the due with the benefit, it can minimize the change of customer to do not pay their debt. And last but not least, early settlement discount with early settlement discount for the customer will stronger the relationship between the creditor and the debtor. It means that it will make customer to use the creditor services and product again, as the creditor like the way that the product, again, as the debtor, like the way the creditor offer as an early settlement discount. Okay, so for the question 1C, compute the current and new cash conversion cycle of Suzam Sdn Bhd. Okay, so for the current cash conversion cycle of Suzam Sdn Bhd, okay, the formula for CCC is A, average age of inventory at average collection period, and minus with average payment period. Okay, so first we find the AAI. Okay, so it was given in the equation that average inventory for Suzam Sdn Bhd is 1 million. Okay, so to find the AAI, 1 million we divide by 10 million and multiply it with 360 days. 360 days. So we get the AAI is 36 days. Okay, so it states in the equation that its receivable conversion period is always twice as long as its inventory conversion period. Therefore, the ACP is 36 we multiply with 2. And we get the ACP is 72 days. So the CCC for the current CCC for Suzam Sdn Bhd is 36 days at 72 days and minus with 30 days, which is the APP for Suzam that given in the equation. So the answer for current CCC is 78 days. Okay, so for the new cash conversion cycle of Suzam Sdn Bhd, okay, so the same way as I explained just now, but the new sale for Suzam Sdn Bhd is 11 million. Okay, so just now, same like just now, to find AAI, we will divide 1 million divide with 11 million and multiply it with 360 days. So we get 32.7. So because it referred to days, so we will change it to 33 days. Okay, so seems like just now that ACP is twice with inventory conversion period. So the ACP is 33 multiply with 2, so we get 66 days. So the new CCC for Suzam Sdn Bhd is 33 plus 66 and minus with 30. So we get 99 days for cash conversion cycle of Suzam Sdn Bhd. So we see that the CCC is decreased. Okay, so for the question 2A, briefly explain the dividend irrelevance theory and the bird in the hand theory. So the answer is, okay, so for the question 2A, briefly explain the dividend irrelevance theory and the bird in the hand theory. Okay, so for the dividend irrelevance theory, Modigliani and Merton Miller, M&M, argues that under certain assumptions, the values of the firm is not affected by its dividend policy. So according to this theory, investors are indifferent between receiving dividends and capital gains. So in a word, without tax, transaction costs or information asymmetry, the total return to investor remain the same regardless of whether company pays dividend or retain earnings for reinvestment. So this theory suggests that the decision to pay dividends or not should not impact the market value of a firm. Okay, so on the other hand, bird in the hand theory suggests that investor prefer receiving dividends today rather than relying on the uncertain future capital gains. Okay, so the theory based on the idea that bird in the hand, which is current dividend, is worth more to investor than the promise of potential future dividends. Okay, so investor may perceive current dividends as more certain and immediate, leading to a higher valuation of companies that pay regular dividends. Okay, so next, the question 2b, discuss about the asymmetric information or signaling, the clienteler effect, and their effects on dividend policy. Okay, so for asymmetric information or signaling, it refers to a situation where one party in a transaction has more information than the other party. For example, in the context of dividends policy, managers often have more information about the company's financial health and future prospect than shareholder. Therefore, dividend decisions can be used as signals to convey information about the company's performance. Okay. Meanwhile, clienteler effect refers to the tendency of investor to be attracted to stocks that fit their preferred dividend policy. Okay, for instance, income-seeking investor may prefer stock with regular and high dividend payments, while growth-oriented investor may prefer companies that reinvest earnings for capital appreciation. Okay, so what the effects of dividend policy? Okay, so for the asymmetric information, it can lead to signaling through dividend policy. Therefore, firms may adjust dividend payment strategically to convey information and manage investor perceptions. Okay, so while clienteler effect, it suggests that the firms may tailor their dividend policies to attract particular investor clientele. Thus, if company change its dividend policy, it may attract certain investor clientele effect. So for the question to C, use the residual dividend model to determine Jalan Jam's total dividend and payout ratio. Okay, so based on the equation, the capital budget is at 100,000, and the equity portion, the capital structure, which is 60% of equity and 40% of debt, and the net profit is 600,000. Okay, so for determine the total dividend, we will first calculate the equity portion of capital budget. The equity portion from the capital budget, which is 60%, we will multiply with 800,000 and we will get 480,000. Okay, so we will minus this equity portion with our net profit, which is 600,000, to get the total dividend. So 600,000 we will minus with 480,000 and we will get 120,000, and that the total dividend that will distribute to the shareholder. Okay, so for determine the payout ratio, we will take the total dividend, which is 120,000. We will divide by our net profit, which is 600,000, and we multiply with 100, and we get 20% of the payout ratio. Okay, so for question 2D, in relation to information in part C above, explain what would happen if net profit is forecast at 400,000. Okay, so if net profit is 400,000, it means that the company do not have enough earning to cover their equity portion that lead to the negative dividends. Therefore, the payout ratio also not applicable in these cases because they do not have funds available for distributing dividends to shareholder. Okay, so we will move to the next question. Question 2E asks for explain one advantage and one disadvantage of residual dividend policy. Okay, so one advantage of the residual policy is its ability to promote the efficient use of resources. So by retaining earning for investment in projects with positive net present value, the company ensures that funds are allocated to opportunities that can potentially generate higher returns. Okay, while the disadvantage of it is uncertainty it introduced for shareholders. Okay, so since dividends are based on residual earnings after meeting investment needs, shareholder may experience inconsistent or unpredictable dividend payment.
For question 3, the key concepts are operating leverage, combined leverage, and financing leverage. For question A, requires us to calculate the degree of operating leverage, the degree of financial leverage, and also the degree of combined leverage before expansion. The first one is we need to calculate the degree of operating leverage. We should take sales minus variable costs and divide it with sales minus variable costs and fixed costs. Then we will get the answer for 2.1. Meanwhile, for degree of financial leverage, EBIT should be divided by EBIT minus interest, and the answer is 1.25. And lastly, for degree of combined leverage, is sales minus with variable costs and divide it with sales minus variable costs, fixed costs, and interest, which lead to 2.625. For question B, we need to construct the income statement for the two alternative financing plans. Basically, both debt and equity have same sales, variable costs, and fixed costs, and will lead to similar EBIT, which is 950,000. However, for interest, debt has 142,000, while equity will remain at 100,000, as interest for debt should be calculated as interest plus interest rate times with expansion costs. Therefore, the earnings after tax will be different due to interest, which is 533,280 for debt and 561,000 for equity. However, common shares for debt will remain the same at 100,000, while equity has 110,000 since it plus with selling of 10,000 shares. And lastly, EPS for debt is 5 ringgit 33 cent, while equity is 5 ringgit 10 cent. For part C, we need to calculate the degree of operating leverage, financial leverage, and combined leverage after expansion. And we managed to get the answer for both the debt and equity. And for degree of operating leverage, for both debt and equity has decreased to 1.84, while degree of financial leverage for debt is 1.18, while for the equity is 1.12. Meanwhile, as for degree of combined leverage, after computing for debt and equity, we managed to get the answer of 2.17 for debt, while 2.01 for equity. For question D requires us to explain which financing plan that we favor and the risk involved with each plan. As calculated above, the debt financing plan provides greater earning per share but provides more risk because of the increased use of debts and higher DFL and DSL as compared to equity financing plan. The question point is explanation for future sales. It is because if the sales are expected to decline or be advanced very slowly, the debt plan will not perform as well as the equity plan. Conversely, with increasing sales, the debt plan becomes more attractive. The debt plan should probably be favored based on the projected overall sales of 2,500 ringgit. For A, the question asks us to describe Modigliani and Miller's arguments in relation to capital structure and influence on firm's value. So the answer is the approach by MM to the capital theory suggests that assuming profit markets, the capital structure that a firm chooses does not affect its value. The perfect world of the Modigliani and Miller theorem is based on first is no taxes, no chance of bankruptcy, and perfectly efficient markets, and lastly symmetric information set for all participants. And there are two proportions which
is MMM proportion 1, which deals with the firm value, and MMM proportion 2, which deals with the weighted average cost of capital, which is WACC.
Question 2E asks for explain one advantage and one disadvantage of residual dividend policy. Okay, so one advantage of the residual policy is its ability to promote the efficient use of resources. So by retaining earning for investment in projects with positive net present value, the company ensures that funds are allocated to opportunities that can potentially generate higher returns. Okay, while the disadvantage of it is uncertainty it introduced for shareholders. Okay, so since dividends are based on residual earnings after meeting investment needs, shareholder may experience inconsistent or unpredictable dividend payment. Okay, so I think that's all for the question 2. We move to the next question, which is question 3.
Moving on to question 4, part A, Ramadan Sdn Bhd is considering purchasing Shawwal Sdn Bhd. Ramadan's analysts project that the merger will result in incremental net cash flow of Rm 1.5 million in year 1, Rm 2 million in year 2, Rm 3 million in year 3, and Rm 5 million in year 4. In addition, Shawwal's year 4 cash flows are expected to grow at a constant rate of 5% after year 4. Assume all cash flow occur at the end of the year, the acquisition would be met immediately if it were undertaken. Shawwal's post-merger beta is estimated to be 1.5. The risk-free rate is 6% and the market risk premium is 4%. What is the value of Shawwal Sdn Bhd to Ramadan Bhd? So the key concept of this question is merger, constant growth model, CAPM model, and perpetuity. To answer this question, we need to first find the interest rate by using capital asset pricing model or CAPM formula, and we will get 12% interest rate to calculate the value of Shawwal. The timeline shows the net cash flow of the merger. We will need to find present value of each cash flow at year 0. The fourth year will have the value of 80, which is the amount after adding up 5 million with 75 million of the present value after the fourth year using the 5% growth rate. Adding up all the present value of year 0, we will get the total value of Rm 55.91 million. This is the value of Shawwal Sdn Bhd to Ramadan Bhd. Part B. Raya Sdn Bhd wants to issue Rm 100 million in new capital to fund new opportunities. If Raya were to raise the Rm 100 million of new capital in a straight debt 20-year bond offering, Raya will have to offer an annual coupon rate of 12%. However, Raya's advisor has suggested a 20-year bond offering with warrants. According to the advisor, Raya could issue 9% annual coupon-bearing debt with 20 warrants per Rm 1000 face value bond. Raya has 1 million shares of stock outstanding at the current price of Rm 25. The warrant can be exercised in 10 years on December 31, 2012 at an exercise price of Rm 30. Each warrant entitles its holder to buy 1 share of Raya stock. After issuing the bonds with warrants, Raya's operation and investment are expected to grow at a constant rate of 10% per year. So the key concept of this question is warrant. The first requirement. If investor pay Rm 1000 for each bond, what is the value of each warrant attached to the bond issue? To find the value of each warrant attached to the bond issue, we should first calculate the straight bond value. Therefore, using financial calculator, input 1000 as future value, 10% as interest, 9% multiplied by 1000 as PMT, 20 as N, and press PV, and we will get the answer of 914 and 86. To get the value of warrant, 1000 minus 914 and 86, and we will get 85.16 cents. To get the value of each warrant attached to the bond issue, which is 20 warrant, we should divide the answer by 20, which is 20 warrant, and we will get the answer of RM 4.26. Moving on to the requirement B, what is the expected total value of Raya in 10 years? The formula for expected total value is total straight bond value plus total value warrants plus total value stock. So total straight bond value is 914.86. Total value warrant is RM 4 ringgit.26 multiplied by 20, and we will get 85.2. And total value stock, using financial calculator, impute 25 as present value, 10% as I, 10 as end, and press FV, and we will get RM 64.84. Therefore, expected total value will be 914 ringgit.86 plus 85.2 plus 64.84, and the answer is 1064 ringgit.98. So expected total value of Raya in 10 years is RM 1064.98. Moving on to the requirement C, if there were no warrant, what would be Raya's price per share in 10 years? What would be the price with the warrants? Firstly, to calculate Raya's price per share, if there were no warrant, 25 multiplied by 11 to the power of 10, we will get price per share of RM 64.84. Next, to get Raya's price per share in 10 years but with the warrant, we multiply 20 by 11 to the power of 10, and we will get Raya's price per share of RM 51.87.
For question number 1, part A, the key concept is free cash flow, and changes in working capital. For question A, in order to compute free cash flow for ABC, we use the FCF formula, which is to minus operating cash flow 20 million with net fixed asset investment, which is the capital expenditure 5 million, and minus net current asset investment, which is the increase in working capital 1 million, and we will get RM 19 million free cash flow. Question B asks about the effect of ABC value due to the changes. First, we need to find the new working capital amounted to RM 1,040,000. Then we calculate the reduce in working capital, which is RM 832,000. Lastly, due to the changes only in working capital, all amount will be the same. So the new FCF will be RM 20 million minus 5,000 depreciation minus 5,000 capital expenditure and minus the new amount of working capital, which is RM 832,000, and we will get RM 19,168,000. For question C, the two reasons companies should hold cash is for strategic investment. With cash, company can get the investment they wanted quickly and able to fund for their research and development. Secondly, it may also due to operational needs because company need to have sufficient cash in hand to cover their daily expense. Next, the third reason is for debt servicing, which is to ensure all creditors will receive their payment when it is due. In part B, the question required us to evaluate the proposed change and more recommendation to firm. First, we calculate the changes in bad debt expense. It shows a decrease of RM 19,600 in bad debt from 50,400 to 30,800. Next is to calculate changes in sales from 900,000 to 825,000, which is a decrease in sale of 75,000. For the cost of marginal investment in account receivable, first we calculate the present SCP by multiplying 3,300,000 of variable cost with 36/360, and we get 330,000. For the new SCP, we take RM 3,025,000 and multiply with 30 over 360. Then we find the difference of the SCP, which is RM 77917, multiply with 15% of opportunity cost, and we get 11,580, which is a decrease in SCP. The analysis is to find out the net effect of the changes. We add 11,580 and 19,600 as it was an increase of value and minus 75,000 for decrease in value, and we get negative 43,820. This implies that Jari Emas Sdn Bhd should not relax its credit standard as it leads to negative net effect.
For question 2, Moneymaker Sdn Bhd wants to expand current operation and needs a finance of 5 million, either by issuing 14% debenture or issuing new shares to existing shareholder. The expansion will increase sales revenue by 20% in the first year. Variable cost of sales make up 60% of the cost of sale, and admin costs will increase by 5%, and the policy of paying out 40% of profit after tax as dividends. The key concept for this question are leverage, share repurchase, and debenture redeemable. And for question A, it requires a forecast statement of profit or loss account after one additional year of operation for both financing plans. And as the question mentions about sales increasing of 20%, therefore sales increase from 45,000 to 54,000 for both financing plans. Cost of sales decreased to 13,000, gross profit increased to 41,000, and the admin cost also increased by 5% to 15,750. And in addition, profit before interest and tax also increased for both financing plans. However, for the interest, there's an increase for debentures while nil in issuing new shares, since issuing new shares did not produce an interest. Therefore, it will lead to difference in profit before tax until the retained earnings for both. Lastly, retained earnings for debenture is 10,479 ringgit, while issuing new shares is 10,605 ringgit. For part B, the question asks for evaluate and comment on the effects of each financing proposal. For earnings per share, we divide retained earnings with the number of common shares, which will lead to 4 ringgit 19 cent for debentures, while 4 ringgit 24 cent for issuing new shares. Meanwhile, financial leverage is obtained by dividing the EBIT with the EBIT minus interest. Thus, the answer is 1.01 for debentures and 1 for new shares. Lastly, for operating leverage, firstly we need to calculate gross profit minus fixed asset, then divide the gross profit with the answers. Therefore, the answer is 1.75 for both. As calculated above, EPS for issuing new shares greater than 14% debentures ensures that by issuing new shares, the company earns more profit as compared to 14 debentures. Meanwhile, for financial leverage, it shows insignificant difference for both. And lastly, both of the financing plans have same operating leverage, which is 1.75, as it does not affected by financing proposal. For part C, the question asks us to discuss arguments for dividend relevance and irrelevance theory. Miller and Modigliani suggest that in financial markets which include certainty, no taxes, no transaction costs, or other market imperfections, the value of a firm is unaffected by the distribution of the dividends. It because the first one is the firm value is determined solely by the earnings power and risk of its asset investment, and the second one is if dividends do affect the value, they do so because of the information content which signals the management future expectations, and lastly, a clienteling effect exists that causes shareholders to receive the level of dividends they expect. However, contrary to dividend irrelevant proponents, Gordon and Liner suggest that those stockholders prefer current dividends and that a positive relationship exists between dividends and market value. Bird in the hand arguments which suggest investors are generally risk averse and attach less risk to current as opposed to future dividends or capital gains, because current dividends are less risky, so investors will lower their required return, thus they will boosting their stock price. For D, the question asks us how can dividends and share repurchase be used to signal managers information about your company's prospect. The first one is dividends. Dividend is paid in share rather than in cash due to insufficient cash and firms wants to promote trading of its stocks. Dividends simply refers to company's announcement of an increase in dividend payout as an indication of positive prospect. Managers with positive investment potential are most likely to signal, while those without such prospect refrain. Meanwhile, in share repurchase, stock repurchase refers to the purchasing and retiring of stock by the issuing corporation. It is a partial liquidation since it decreases the number of shares outstanding. Besides, when a company buys back a share, it may be an indication that the company is facing very positive prospects that will place upward pressure on the stock price.
In question 3, the key concept is merger. For question 3a, we are required to calculate the approximate maximum cash price AMC would be willing to pay for HME. In this question, we will need to know the present value of inflow and the amount of liquidation of asset of the target company to get the maximum price AMC willing to pay. First, we need to find the cash inflow, which is by using the tax loss carry forward of HME. We deduct the amount of tax without merger with amount of tax after merger by utilizing the tax loss carry forward to find the tax benefit, which is the cash inflow for each year. After that, we will find the present value of the inflow using the amount of cash inflow we get before using the financial calculator. We get total present value of inflow of RM526,593.5 and add the liquidation of asset amounting to 3,250,000 to get the maximum price of RM3,776,593.57. For question 3b, we will discuss possible takeover defense tactic HMC can use if they don't want to be taken over by AMC. First is White Knight. It is a defense strategy where a friendly company takes over the target company instead of a hostile bidder or a Black Knight. The friendly company will offer better term and bid price than the hostile acquirer. Next is Poison Pill. It is a distribution to the target's shareholders for the right to purchase shares at a very low price when takeover is attempted. This will make the acquisition become expensive and become unattractive to the shareholder. Furthermore, Golden Parachute can also be used by providing additional to the target's company top management in case of termination of employment if the acquisition is successful. This will also increase acquiring costs and therefore discourage potential acquirer. Besides, Green Mail can be used by buying back shares from hostile company at a premium over the market price, which will make acquirer not to pursue obtaining the target company. Lastly, leverage recapitalization, which is by changing the capital structure of the company in a way that can increase its financial leverage and making the target company to be unattractive to the acquirer. For question 3C1 Roman, the question required us to calculate the purchase price of the merger if the merged firm is worth RM80,000. First, due to the merger, the number of outstanding shares will increase to 800 by adding 600 of AMC current number of outstanding shares with 200 upon merger. Then we calculate the price per share by dividing RM80,000 with 800 number of shares outstanding. Lastly, we find the purchase price of merger by multiplying RM100 price per share with 200 of shares upon merger, and we get the final amount of RM20,000. In question 2 Roman, AMC EPS will be calculated by dividing earning with the number of shares outstanding. The EPS before merger is 6.67 and EPS after merger is RM7.25. For the PE ratio, the PE ratio after merger is 13.8 and before merger is 10.5. This also shows an increase in the ratio. For question 3 Roman, 4 ways AMC can tackle employees-related challenges of merger and acquisition is by communicating changes to the employees. Failure to communicate will cause company synergies to fail in merger and acquisition. Employees and management should be provided with information to avoid the employees left in the dark. Then, the company should also keep employees motivated. During M&A, employees need to examine the consequences of human perspective, especially the impact on employee motivation. Merger can affect organizational climate, work assignment, and group dynamic, which can also affect employees' motivation. Cultural integration can also help to tackle the problem. Understanding the cultural nuance of each organization can foster a harmonious blend. For example, employees can create cross-functional teams to bridge cultural gaps and promote inclusivity. Lastly, employees need to be transparent. Being honest and transparent at every step of M&A process is crucial to build trust and keep employees engaged. For example, internal communication department should do their best in communicating both sides to the both parties.
In question 4, the key concepts are option and convertible and derivatives. For part A, question A, the question requires us to find the profit on stock transaction for net profit computation. We just need to deduct the market price and exercise price and each multiply with 100 shares and we get the profit of 500 ringgit. For question B, the question is about the profit on option transaction. We also need to deduct the market price with exercise price and multiply with 100 and we get 500 ringgit. Then minus the 200 cost to get the profit of 300 ringgit. For question C, the break-even share price is 27 ringgit, which is by adding up 25 ringgit exercise price with 2 ringgit, which was obtained from dividing 200 cost to each shares. And for question D, Amelia should proceed with the call option as its strike price is below the market price of the share, which also means Amelia will be profitable if she make the transaction. However, in part B, the question requires us to calculate the implied price of the warrant. Firstly, we need to find the straight bond value using the financial calculator, which is 863 ringgit 78 cents. Then we can calculate the implied price for the warrant by deducting the price of bond with warrant, which is 1020, with straight bond value of 863 ringgit 78 cents to get the implied price of 156 ringgit 22 cents, and divide by 10 warrant to get the implied price for each warrant. And for part C, explain the general relationship between the theoretical and market values of a warrant and the circumstances that make the two values quite close. So the answer is, the general relationship between the theoretical and market value of a warrant is that the market value of a warrant is generally above its theoretical value. Next, the market value and theoretical values close only when the theoretical values is very high or the warrant is near the expiration date. The difference between both values is called warrant premium, which is when market values exceeds the theoretical value and result from both positive expectation and ability to trade them.
That's all from us. Thank you.